and monetary actions have been very positive, and we expect to see gradual, steady improvement in the MFI segment in the coming few months. With the ongoing challenges in the microfinance sector, our team has worked well to manage the situation. During the quarter, while loan growth and profitability slowed moderate progress versus our guidance and budgets, we remain encouraged by the continued resilience across key operational metrics. Notably, we observe a consistent increase in the share of the secured loan book, robust growth in retail term deposits, and a reduced reliance on bulk deposits. That has contributed to a more diversified book and a stable and sustainable funding profile. Even with elevated slippages, headline GNPA and NNPA ratios that have remained broadly stable on a sequential basis. In fact, it has come down, underscoring effect asset quality management, and additionally, our strong capital adequacy position provides a solid foundation for sustained growth and improved performance in the coming quarters. Despite the stress in the MFI segment during the second half of the year, which has resulted into elevated credit costs, the bank navigated these challenges with resilience and focus, and I am pleased to report that for the full year financial year 25, we delivered a reasonably strong performance. I can say with confidence that probably we are one of the very few financial institutions who have a sizable microfinance portfolio but has shown a year-to-year growth in almost all the parameters if we consider the full year's performance. The net interest income has been rupees 11,491 crore, showing a growth of 11%. The net total income is 14,458 crores, showing a growth of 16%. Operating profit 7,389 crores, showing a growth of 11%. And the profit after tax, that is the net profit, at 2,745 crores, which is showing a growth of 23% year to year. The ROA has stood at 1.5% and ROE for the full year is 11.6%. For the quarter 4 performance, as of March 25, our advances book stood at 1.37 lakh crore, reflecting a year-on-year growth of approximately 10%. On the deposit side, deposits have reached 1.51 lakh crore. It shows a year-on-year growth of 12%, and the more important thing is that it outpaces the growth in advances. We remain focused on strengthening our granular liability franchise, and our deposit growth continues to outstrip the growth in the credit. Retail term deposits has grown strongly at 30% YoY. It highlights the growing trust and engagement from our individual customers. The CASA deposits now represent 31% of the total deposit base, bringing the total share of retail deposits, that is both CASA and retail term deposits, at 69%. This marks a significant improvement in the granularity and stability of our deposit base. Additionally, we have effectively managed our funding mix by containing the bulk deposits to 31% of our total deposits, further reducing concentration risk and enhancing balance sheet resilience. We continue to make steady progress on our diversification strategy. In this quarter, our secured book grew by 32% YoY, improving the secured mix to 50.5% compared to 42% in financial year 24. We remain firmly committed to maintaining asset quality. While credit costs remain elevated at present, we are focused on bringing them down over the couple of quarters. During the quarter, we have technically written off rupees 1,136 crores. Despite an increase in slippages and higher upgradation and recoveries, our headline asset quality remains largely stable, with GNPA at 4.7% and NNPA at 1.3%. PCR, which includes the technical write-off portfolio also, is higher at 86.5%. For Q4, the net total income was rupees 3,456 crores and operating profit was 1,571 crores. The bank reported PAT of 380 crores for the quarter. Looking forward, as the MFI environment stabilizes, we are confident that we are well positioned to take advantage of the emerging opportunities. Our focus will remain on sound risk management, exploring new growth areas, and continuing to enhance operational efficiency. Now, I would like to highlight the strategic priorities for the next 2 to 3 years. Over the next couple of years, our strategic priorities will center on achieving deposit growth that outpaces the advances growth, with a strong emphasis on stable, granular retail deposits. We aim to expand our asset book with an improved secured mix, enhance asset quality, and continue investing in technology to elevate both customer experience and operational efficiency. Guided by a clear roadmap that embeds risk management and compliances into every facet of our operations, we remain optimistic about unlocking greater value for our stakeholders. Given the current macroeconomic environment, we are targeting an advanced growth of 15 to 17 CAGR over the next 2 3 years, with a strategic focus on increasing the secured mix. We expect secured advances to constitute over 55% of the total advances by financial year 27. While both the secured portfolio and the EEB book are expected to grow, the secured book will grow at a relatively